here we are with Stani Kulechov. He's the founder and CEO of Aave, the second largest DeFi platform by total value locked right now, which is amazing considering they started off the year at basically zero value locked. So I'm super excited to chat with you about what's going on in Aave and all the recent developments so far. Thank you so much for joining me in the Defiant podcast.
Yeah, thank you so much, Camila, for having me here. Glad to discuss some DeFi related things.
Yay, of course. So briefly, before we get into all the latest developments, I'd love to get more of the background on how Aave came to be, because before Aave there was ETHLend and the ICO and going through all the roughness of the bear market. So can you first provide that background of the period before Aave?
Yeah, definitely. So basically, as a protocol, Aave Protocol, we started this year in January. Year before, basically, we rebranded to Aave, but before that, we used to go by the name of ETHLend, which is short for Ethereum lending. And basically, what Ethereum lending was back then was just a small project that I basically founded while I was studying law in University of Helsinki. Finland, where I'm originally from. And what actually happened is that we started as a community project, and we wanted to create basically the first lending protocol on Ethereum and kind of like test how we could create a bit more complex financial transaction than trading or transferring funds from one address to another. And one thing led to another. We had a interesting market back then, and this was ages before stable coins or liquidity pools and any kind of like idea of total locked value. And I think the transition from ETHLend to Aave was kind of natural as kind of like we saw liquidity starting to pool together, and we started to think like how we could utilize more this locked liquidity, locked value in a more capital efficient way. And that is how we came with the Aave protocol.
Right. Because was ETHLend more of like a peer-to-peer lending structure than a pooled liquidity structure?
Yeah, definitely. So we started back then with the peer-to-peer model because we heavily believed and still believe that kind of the idea of decentralized finance, and for us it was just financing in terms of like smart contracts because the term wasn't coined back then yet. But the idea is that you could actually like democratize a bit the interactions, so anyone can build permissionlessly and participate permissionlessly into the ecosystem. And that is what's like very fascinating. And basically we choose the peer-to-peer model also because like we try to separate risks as much as we could. And basically back then the tokens that where on Ethereum, for example, didn't have that much liquidity. So we didn't want to go with a systemic model. And now we see like many models in terms of like liquidity pooling, whether it's trading or lending, that is actually a functional model if you have incentives network for liquidations and kind of like this kind of incentives that will ensure that your protocol will be healthy. And that's kind of like why we transferred from one model to another as we saw it becoming the thing to do.
Got it. And I thought when you first launched, it was interesting to see that you were kind of innovating right off with the A tokens, kind of building from what Compound had done with C tokens, but modifying that structure a little bit. So can you explain like when you launched Aave, what were the main things that you were trying to innovate with at the time?
Yeah, I think I'm a really big fan of the C tokens, and kind of like what I wanted to do with our team is that with the A tokens that we wanted to somehow make interest-bearing tokens in a way that you could actually understand like how much you're earning in terms of what you're depositing. And it's actually like our goal was just to kind of like focus more on the end user user experience.
Mm-hmm.
So that, for example, if I deposit 100 DAI into the Aave protocol, and I get 100 ADAI as a kind of like an interest-bearing token in return, and we wanted to have this 1:1 ratio, so that you could actually understand like how much is deposited, but also that whatever you're earning in the protocol, it actually grows with the balance. And this basically means that we added into the A token smart contracts and an algorithm that is based on the interest rate model of the protocol, which updates the balances of all of the A token holders. So you will constantly see if you're holding A tokens in MetaMask or in some other basically wallet, you will see the balance all the time increasing. And why it's important is that you actually know how much you're earning, and also it kind of like gives you access to a global permissionless savings account, which is dollar nominated at the moment with the DAI, USDC, and USDT A token versions. And that's very important in places, for example, like Venezuela, in other countries in Latin America. For example, Argentina is a good example where you could basically just by holding A tokens, whether by depositing or by buying them, you basically hold this permissionless access to basically savings account this way. And it's quite interesting because especially if your local currency has high inflation, and I think in one way it really democratizes and shows what you could actually do with DeFi with just this small interesting function.
Yeah, no, I agree. So for those listening or reading who are not that familiar with these types of tokens, it's a super interesting concept, which is representing a lending deposit or tokens deposited in a lending protocol with tokens in your MetaMask wallet or in your Ethereum wallet. So it's kind of like a derivative of your token deposits. But what's interesting is that the token itself starts growing in value as you start gaining interest. So that's why they're called interest gaining tokens. And it's really cool that it does kind of democratize access to a dollar savings account for anyone in the world. And yeah, Aave and Compound are two of kind of the main lending protocols offering these types of tokens. So from there, from launch early in the year, value locked in Aave has completely skyrocketed. So what do you think are the main milestones in this trajectory?
Yeah, I mean, we weren't expecting this kind of traction at all. I mean, DeFi in general has been growing quite a lot, above my expectations. I always projected DeFi to grow a lot in terms of based on the things has been building Aave, what Aave has been building, what others have been building. And kind of what I see now is that we get more and more adoption. And it's just funny because we're still in the very, very beginning in the sense that there's many things that could be still built. And we will probably see quite interesting DeFi primitives on top. For us personally, I think the biggest kind of milestone for us to see was to see flash loans to get utilized. Because in the beginning, we started to kind of introduce the functionality to developers that, hey, you could build very interesting DeFi composability things, which basically means when you take a couple of DeFi building blocks, let's say you use Aave, you use Compound, Uniswap, and you make some kind of a product, and you use flash loans to basically reduce the need of actually capital to do some kind of a transaction. And we saw a few months ago that actually flash loans started to get a lot of traction. And now on a daily basis, we have quite a lot of flash loans. And in some days we have over 100 million worth of flash loans.
Amazing.
And that for me is very nice to see actually. And other things that has been substantially important to our team is the amount of developers that are building on top of Aave or are utilizing, for example, Aave. And I think that's pretty cool stuff now. And Yeah, and we're trying to just to innovate as much as we can, create new products and services, and try to just make kind of like the DeFi experience as seamless as possible and get most out of it
Yeah.
for the users.
So I wanted to stop a little bit on the flash loans concept, which, you know, again, for those listening, it's this really interesting idea or ability for DeFi users to take out a loan on one Ethereum transaction, use that money borrowed to execute any type of trade in any other DeFi protocol outside of the platform that you took out the loan to begin with, and then pay back the loan on the same transaction, potentially with the profits that you made from whatever trade you're doing. So, you know, this needs to be automated and requires like some level of skill, because you need to kind of code these trades up. But it does allow anyone to participate in this system without having that much capital to start out with, because you're executing these trades with money that's borrowed, and you get to keep those profits as long as you pay the loan back in the same Ethereum transaction. Let me know, Stani, if that was a good explanation for it.
Yeah, totally. I think that was exactly very good explanation. Like flash loans is a functionality that mostly now maybe developers are using. There are kind of ways to use it with no code functionality. For example, there's an app called Furu Combo that does that you can actually just drag and drop and make functionality experiment. But like it's all about developers building new products for end users to basically make them capital efficient transactions in Ethereum, and I think that's the kind of like a key point where we are with flash loans. And flash loans are like, it's just a functionality, but it's part of the bigger picture of our protocol, basically utilizing capital as efficiently as we can with innovation. And one of the other things amongst flash loans and A tokens is basically credit delegation that we announced a while back ago. And basically that allows anyone who deposits into Aave to earn interest to basically delegate their credit line to someone they trust, or to a smart contract that does some functionality, some kind of strategies that are pre-programmed, that basically there's less risk of failure. And this is like the idea of like, averagely we calculated that every fourth user who is depositing into Aave, or let's say from the capital, 20% is somewhat utilized, and the rest 75% is available liquidity for flash loans or basically non-utilized. And the credit delegation was basically a way of kind of like increasing that utilization rate by allowing other peoples that don't have collaterals but are in trust relationship or building some smart contract functionality to actually draw that credit on behalf of others. And for depositors that are actually delegating credit, for them it's pretty cool because they can earn additional yield, and that's really interesting.
That's very cool. I thought this was a really innovative concept and a way to get around this dilemma in DeFi, which is that up until now, you kind of need a lot of capital to borrow. All of the loans in DeFi are over collateralized. And you know the reason why that happens is because for the system to be permissionless, you can't be checking somebody's credit score or doing KYC or demanding, you know, like salary and income statements or anything like that. It just needs to depend on the money you have. So that's kind of limited the number of users that can actually use DeFi, because you're requiring to have money up front. But you know, this is a way to get around that, I think, right? By delegating, if you have capital, you can kind of delegate that collateral so someone else can take an unsecured loan. What I don't get is how does the person who is delegating their collateral know how trustworthy the borrower is?
Yeah, that's a good question, because it boils down to the actual lending facility or like lending models where you kind of are entering into trust relationship. So basically, the very interesting scenario, because there's different kinds of trust relationships. People lend money, for example, for their family members, friends, so there's some trust. There are businesses that are doing the same, but they're lending out to, let's say, consumers, businesses based on the risk scoring. So as a function, like the credit delegation idea is to kind of like open the floodgates to delegate that credit and source DeFi liquidity out of protocols like Aave. But end of the day, about the underwriting, it's kind of like opportunity for different kinds of protocol models or business models to create functionality where they can do some sort of credit risk assessment, for example. I think three very easy scenarios is where you're delegating credit line to someone you can basically trust. You can even do that with just a verbal agreement, formal agreement with open law that we used, for example, with the very first credit delegation to diversify. And the second way, for example, you can use the very same thing, but you could, for example, a group of persons or delegators could delegate to a entity that could be in the traditional finance. So they could delegate them to borrow stable coins that they convert into fiat, and then they lend it out basically into their clients, for example. Okay. And I could see that in the future, for example, like our objective will be fulfilled if someone in the street who is walking who bought a car or who basically bought a house, partially of that purchasing power is sourced from DeFi with credit delegation. And it's kind of like it doesn't like the underwriting. It's a one own form of a business model. For example, there is a project called Union Teller who are actually working on this kind of stuff where basically they're trying to bring efficiency in terms of underwriting loans in the decentralized finance and utilizing them. But I think we'll see like a lot of kind of various differences. And the third one, which is actually even more fascinating to me, is that you could actually delegate credit to a smart contract that does some functionality. For example, we have a protocol called YEarn, and one of their vaults, so they have this kind of like a vaults that are doing some sort of strategy, trading, yield farming, and one of the vaults is based on basically A-Link token, which is delegated token of the A tokens to that vault. Okay. And that vault draws credit line with the delegation from Aave. And that's a good example to basically have, I think, like farming activities. So that's a good example of what we do.
Okay, wait, I'm not sure I got it. But first, let's kind of go over the other examples. So in the first case, which is kind of the simpler case, is that you're delegating your borrowing power to people you know, like your friends and family. Yep. Then there's the second case, which I think is a way to scale up this operation, is for entities to delegate their borrowing power to their own clients. So if, for example, fintechs in traditional finance who already do KYC on their customers and know that they are credit worthy, they can delegate their lending power and allow those customers to borrow through Aave.
Exactly.
Kind of, okay. And then the third option would be for to have like smart contracts execute that loan, and you named this example with vaults in YEarn, but I didn't get that part of the example.
Yeah, exactly. So what's interesting about this basically delegating to a smart contract is that basically you could delegate to a smart contract that can only do predefined functions. So let's say in terms of YEarn, you're basically delegating your credit to the vault, YEarn vault. And what happens there is that you basically give the permission of that vault to draw a credit line against your deposits into Aave. So basically, when the vault functionality is basically called, it draws credit from Aave and basically deposits those funds into, for example, Curve, to yield farm. And
Okay.
the smart contract can't do anything else. So that's the beauty out of it, because it's a predefined strategy, it's immutable, and you're reutilizing the capital that is basically locked as a TVL in Aave in functions that are basically can't be changed, and it eliminates the credit risk there. So it's kind of different than the lending to people that you trust or under legal agreements, because actually the more you create different kind of functionality in smart contracts, pretty defined, and the more like DeFi grows and these opportunities will come, we might see like more scaling there into this direction. And I really love when we have basically smart contract based infrastructure and we don't need to resort to, let's say, legal agreements and enforcement. So for me, it's very fascinating what's happening on the smart contract side, Delegate.
Okay, I got it. So, so these loans would be used to execute different trading strategies by smart contracts. That's really interesting. Are there any examples of this happening yet, or is it just something that you think would be a good way to use this functionality?
Yeah, smart contract to smart contract based credit delegation is already utilized by Wire. So they're drawing credit lines from Aave and basically depositing into different protocols, the stable coins to generate more yield. And that's already happening. And
Nice.
I will bet that this will be expanding in the future as well. And I think I made the first proposal, I think it was yesterday, into the Iron community, where actually we could create more of these vaults and basically expand the credit delegation and those strategies. So that's pretty interesting to see how it will develop.
Yeah, so interesting. So how much would you say right now is being borrowed through this mechanism in general, like taking all these different strategies?
Yeah, I think the amounts aren't that big at the moment. I think we have, I'm not sure quite the number, because I haven't checked like how much the utilization is there, but I would expect somewhere below 1 million still. And I think in the future it will go. It might be more. It really I haven't checked like how utilized it is, but it's interesting to actually follow like how it's going to develop.
Yeah, as with so many things in DeFi, these things tend to kind of grow exponentially and just like pick up from like one day to the next. So I wouldn't be surprised if, yeah.
And the thing is that we always tend to focus on kind of like the permissionless aspect of the users, but we kind of, what's happening in the permissionless aspect in DeFi in terms of development, that's even more interesting, because like anyone can develop this kind of products, and anyone can, I could imagine in the future in Aave governance that someone could propose this kind of vaults, and there could be like a credit delegation functionality that could be done in the user interface to kind of choose which vault you want to delegate and what kind of yields they give you. And I could imagine the Aave governance voting on what kind of vaults could be approved into the system, depending on their security, depending on their risk assessment, and so forth.
Yeah. Okay, so speaking of governance, I wanted to also speak about Aave's V2 and transition to more decentralized governance. Would love for you to give kind of an overview of this upgrade of the protocol.
Yeah, I mean, so now what's interesting, like the actual narrative behind, because when we launched in January and we saw like the protocol growing over the time, and currently we have roughly 1.3, 1.4 billion locked value in the smart contracts, and the market size is even bigger, 1.5 and so forth. Like we see like the stakes are very high, and we feel that we as a team, we cannot anymore basically govern the protocol in the sense that we have delivered the base layer of the infrastructure, basically. So we have a base layer of infrastructure now, and we're updating it to version 2, where we basically are adding more optimization in terms of gas and more functionality. But the underlying idea there is that now it's kind of the time that we give the power of the making changes to the protocol and vote on the features and changes to the Aave governance. And this is why we're having basically a token migration from Lend to Aave. And basically after that happens, and after we transferred keys to the Aave governance, it's basically up to the governance to decide what Aave, the team, will be building and what other developers could be built. So in the future, anyone could build features, functionality into the core Aave in the next upcoming versions, or additional features on top. And that's what will make it very interesting. And of course, anyone can propose as well these updates. And I think I think we tend to still underestimate the power of the governance, because the more we give the kind of decision making for the governance, the more we have expertise and the more we have vision how the project should be developed in the further. And this is what got me into DeFi and Ethereum in the first place, because it's not about anymore few bankers deciding in cafeteria in London on how basically the company should be run, but actually now anyone can participate. And that also means that you need to build a product or a protocol that actually is suitable for all parts of the words and demographics. So that is very fascinating for me.
Yeah, no, I agree. So in this new governance system, will it be kind of a DAO and token-based voting? Like Aave token holders will propose changes to the protocol and vote on those changes through a DAO?
Yeah, exactly.
Okay.
So the most key thing about Aave protocol is that the Aave token holders are basically voting on decisions, and most of the decision, because of the value locked in the smart contracts, are based on risk. So they're already holding the risk of the locked funds there and the market activity. And they're also voting on the risk parameters and what assets could be added into the protocol. I could imagine there will be in the future decentralized risk teams giving proposals, how things could be changed. And when the Aave token holders are basically deciding upon this risk, they're also at the same time bearing the risk, which basically means that in our Aavenomics, which is so-called token economics, what we have is a functionality of staking, where the token holders can stake their tokens into a safety module. And if there's some sort of a shortfall event, such as smart contract hack or a bug or any kind of a failed liquidation, or the governance sees that this thing led to deficit in the protocol, basically those stake tokens could be used to cover the deficit. And if it's not enough, basically there is a minting facility as well, and cover this kind of a deficit. And what's important here is that the Aave token holders are kind of setting those risk parameters, and at the same time they're bearing that risk as well with the providing the safetiness. And the key component here is that we, over the past 6 months where we were designing the Aavenomics, we tried to think of what is the most important thing for DeFi or for Aave. And one of the things that rang the bell all the time was we have to ensure the safety of the infrastructure of the whole ecosystem and our protocol. And that is how we get adoption, when basically people can trust that the code has been verified and it has been diligently deployed. But also, if there is some sort of a shortfall event and something bad happens, it could be somehow covered and life can continue.
Right.
And that was our idea on how we see risk playing a very major role in the governance.
That's interesting. So for Aavenomics, I guess the key difference with maybe other protocols is that you have this kind of token reserve that's made by token holders staking their tokens, and this reserve is there in case anything bad happens and you need to cover maybe a shortfall in collateral, like what happened with Maker in March.
Exactly.
Right.
So basically, what's interesting, during the past 6 months, we took a lot of inspiration from Maker. We took inspiration with different protocols, and from the backstop syndicate. That was the idea of that was basically to buy that maker tokens that were minted and kind of like building that system as well. And also we're looking at other staking DAOs. And one of the biggest kind of like interesting like inspiration for us was Ethereum, because in essence, like what Ether is, it's basically transaction gas, but also it's a way to secure the network. It basically, miners who are confirming transactions, they're upholding the security for the Ethereum network, and they're getting rewards via inflation and also the transaction costs. And kind of like we saw that this kind of element of like, rather than focusing completely on rewarding liquidity providers for making the market, we need to also ensure that those liquidity providers are basically safe, and we have modules that kind of like incentivizes them to deposit, and we can ensure that if there is such like Black Thursday event and bad liquidations, it doesn't create this kind of like a downside effect where people are leaving DeFi because of there's just too much risk. And the risk is very high because all of the code that is developed, it's public there. So it's really important functionality we understood.
Yeah, for sure. So can you talk about the token distribution and how much of the tokens will be, as a percentage, will be held by Aave team and Aave like early investors?
Yeah, so basically, I think in the current sense, maybe the Aave team and early investors probably have 1/5 of the token supply, which is very low, but it has kind of good perspective in the sense that the token holder base is quite decentralized already, because we see a lot of projects when they start their DeFi project, it starts in a way where the early investors have most of the supply, and gradually with different kinds of like liquidity incentive schemes, the tokens are going from the let's say the founding teams to the users, at least in terms of percentage. And what's interesting about like the incentives is that we have actually very interesting system in a way that part of the incentives are for the stakers who are providing the safety, and part are for the liquidity providers who are providing the liquidity. And now we have our governance, basically an open discussion, like how to balance between the liquidity providers and stakers, and like what's the ratio should be, and kind of like to incentivize the safety nets, but at the same time to bring long-term liquidity providers. And this is like an interesting discussion that we are now we have been discussing, and kind of like we see that it's a bit like our community is very oriented into the safety nets. But what's cool about the Aavenomics is that if you provide liquidity and get rewards, you can compound them into the safety protocol. So if you are incentivized to do that, you might be a liquidity provider that cares more about the protocol health than, for example, a liquidity provider that farms, let's say, tokens to sell them quickly.
Got it. Okay, because so what happens there is that liquidity providers can then use those rewards to add staking to kind of provide the safety net for Aave, and so maybe that way both incentives are kind of aligned, like liquidity providers and the safety of Aave. Interesting.
Exactly. So our goal is basically when a liquidity provider steps into the Aave protocol, they basically are incentivized enough to kind of like keep the healthiness of the protocol in mind, and kind of like see the protocol as a long-term kind of like an investment for them. And I think that's important because when we have different kinds of governance involved, it will be very difficult if on one side we have liquidity providers that they want quick returns, but on the other side we have basically people who want to provide safetyness. In this way, you have incentives aligned, and they're all basically towards providing more safety.
Right, but right now it's still in discussion how much each group will get of like new Aave tokens. Okay.
So whatever the community decides, we will basically implement it. So that's our kind of like a goal as to start it. And interesting part is that those incentives can always change. The governance can vote again. And I think now recently, for the past 6 months, or even like the recent months, we've seen like governance working pretty well in different projects, and kind of like creating proposals and kind of like looking at long-term, looking in general long-term on all the protocols that basically the decision making that I have seen in DeFi in terms of governance has been very, really impressive.
Yeah, I agree. Yeah, these tokens have certainly kind of launched this really active community, and incentivized them to like really become involved in the protocols that they're using, and propose different kinds of changes, and participate in voting. I was really surprised to see something like the YAM community really spring to action to save this token, which was kind of born overnight. So I think that was a really good example of kind of decentralized governance. But at the same time, there have been, we've been starting to see the kind of the temptation that I guess some teams might fall into, or the risks of decentralized governance suddenly becoming concentrated again. I'm thinking about curve finance, and how, with the incentive to lock up CRV token, the team now holds like 70% of voting power, because they were the first to lock in their tokens. So interested in your thoughts on this, like how to balance keeping a governance system decentralized with kind of the obvious incentive for the team to also keep some level of control of the protocol, especially when stakes are so high, with hundreds of millions of dollars locked, or billions of dollars in your case.
That's a very, very good and question, because in terms of like in the beginning, it's kind of like very flexible if the team has power to make changes, and especially when you need to do rapid fixes, or just like decision making where action is needed, and kind of like you need flexibility. But over the time, when the protocol starts to grow and there's more and more assets and funds involved that are basically from external parties and from the community, I think it has to start already thinking like how to become more decentralized. And one of the best learnings I had past years is basically the more you give power to the governance, the more healthier and stronger your governance is. The earlier you can do it, the better. I mean, there's no reason for the team to keep majority control of a protocol. If the protocol code is safe enough and basically battle tested after a few months and so forth, it is fair to already start kind of like transferring that power as much as possible. And the way I have seen that only good thing happens like when, well, can't say only good things. I mean, it depends on the communities, but I've seen like very positive effects when you do that. And starting that as early as possible is very important. For our plan was basically started even more earlier, but basically we were a very small team, and we wanted to make sure that when we are shipping code or we are doing changes, we do them very diligently, and we put a lot of effort in there. And also it's kind of like question of development. Now that the Aave protocol is holding vast amount of funds, our development process is a bit slower, in the sense that we are innovating as fast as we can, but we also need to be very diligent when we're deploying things. And I think new protocols that are launching, new products and token economics, I think they should really think about it like in the very beginning, like how much time they need to keep power and to what extent. Do you even need the majority power in the very beginning? And how you could decentralize it a bit more? Could you actually have some sort of a kind of like a time frame of, let's say, once you deploy your main functionality, and after, let's say, 1 month after that, you could transfer the keys to larger audience. And it also, like, I think in terms of like protocols we have seen now, it's more about question of fair distribution models. And we have seen models where basically the early investors, they have majority of the token supply. So you can't call it decentralized until you can, you as a team can be challenged on every single decision you basically make or proposal you make. And once that you reach that level, then you are like decentralized enough, in my opinion. And that requires that the team and the investors, and even like inner circle or kind of like, if there is something like that, basically doesn't hold the majority of the voting power. For me, that's the kind of like a landmark of kind of like being actually having fair distribution model and being decentralized enough.
Yeah, no, makes sense. So I guess what you're saying is that when you're first starting with a protocol, it makes more sense to have the tokens and control of the protocol in the hands of a reduced number of people of the team, so that they're able to make sure that it's being built in, you know, the safest way possible for users, and that they're able to quickly react if something goes wrong. But over time, as the protocol becomes more tested and safer, maybe when audits are done, then it's maybe the right time to start giving up that power, so that the protocol can become increasingly decentralized. And you're saying that a protocol can only become decentralized once the tokens and voting power of the team are distributed among the community and not so concentrated in the team itself. And I guess it's maybe a subjective measure, like how much is too much of concentration, but you know, that's something that the community itself can discuss.
Yeah, from my experience, honestly, the investors and the team, they don't need as much as they think, because what we're building is very big things, and we should have as less concentration as possible. These protocols will be very, very big, and what's different from compared to traditional networks, payment networks, or any kind of like a trading venues and facilities, is that these might become even bigger. And you don't want to hold that responsibility. You don't want to be responsible of vast amount of funds of kind of like end users. And definitely, like, that's like a very something that I have learned that and I think, like, of course, like, you should not even like deploy any code to the production without audit. So that's like something that the community in DeFi needs to kind of like come together and just like find ways to fund audits. And I mean, there's ways to do that. So, but beyond that particular thing, I think people should kind of like think of more innovative models, how you could kind of like come up with variations of this fair distribution model, for example, and decentralization. I mean, could there be a way, for example, that in the beginning when you deploy something, maybe there's 20-30% from the community that holds a key, or like 10 persons at the very beginning. And we have seen situations where you have one key into a smart contract which holds a few hundred millions worth of value, and then the community starts to panic and arranging multi-signature wallets for that with multiple persons. I think when you're deploying, it's not it's not that interesting to copy paste what someone else done, but actually trying to improve a bit and thinking like what could be a bit more improved iteration of what basically has happened before. And I would really encourage people to kind of like innovate on fair distribution model, how you could launch in a decentralized fashion and move towards decentralization. You don't need to be aggressively like decentralization in the very beginning, but to a certain extent that you can actually that kind of like the trust and the concentration doesn't rely on a single entity.
Yeah, no, that's a fair point. There needs to be more innovation in this regard. I think we're so early in these new distribution systems that I doubt that we've arrived at the right model to do this. I wanted to touch on what you said on the need to deploy code that's been audited, and you know how hard it's been in DeFi, because of how expensive audits are. So I'm interested in this question of kind of balancing innovation with like really secure and audited code. Do you think maybe there's a middle ground, or like how can kind of a lone developer who's building a DeFi protocol go about deploying code without an audit and kind of handling those risks? Or do you think that they simply just shouldn't do it and be always on testnet before they can manage to get an audit?
That's an interesting one, because the way I see, there's multiple ways to handle the audits. There is a way to basically attract community and actually ask from the community, can we basically split the funds, or is there some community auditor that could help? And basically there's different models. You could always reach older projects, for example, like Aave, and ask, hey, we're building this interesting thing, and it's very important for DeFi. Like, can you basically help us somehow? We have grant program available where you can actually ask grants for whatever you're building, whatever you're researching, and basically including audits. So those kind of things we are helping out. But I think one of the things we can distinguish is that there has been this kind of like a way of deploying it without anyone knowing and creating some kind of like a rush into the project in a way that you want to quickly distribute the tokens and get quickly people involved. And this has had the function of like not auditing some code and putting disclaimers, and which is like the disclaimers will not help if you are kind of creating the rush there and basically your idea is to get people quickly to deposit. It will not help. I mean, it's just like human psychology isn't like capable of like resisting that kind of things, you know. People are led by greed sometimes, so it doesn't help. So that is important for a developer, every developer that is deploying into mainnet, just to basically understand the risk and understand that everyone needs to do their best practices and to ensure that not audited code can go into mainnet for use. And I think just by reaching out and creating communities first, there is no rush into deploying code. I mean, I would rather see communities grow first and then the products grow in there, and kind of the communities coming together and basically helping out to get those audits, asking grants. And this is like the healthy way of like getting a funding bootstrap. And if you want, you can always go to the venture capital. It's not the most preferred model. And there's different kinds of ways, but definitely I see there's more potential in actually building communities first and then building the product and then launching. And kind of like that's very interesting, because like the community will help your product to build, and that's like substantial help.
Right. So would you rather see less of these protocols kind of launching overnight and getting a bunch of liquidity with these, you know, yield farming incentives and tokens before having an audit?
Yeah, because if your code is public and basically everyone can look at it for a certain period of time and launch, basically that gives more reassurance. There are people from the community who can audit the code and take a look before they implement. You can arrange partnerships if you're basically using different protocols and kind of discuss with their staff, their developers. They can basically read the code and review. So time only is kind of like a positive thing in DeFi. We somehow created an environment recently that you kind of need to develop quickly. Once it's ready, you need to deploy it into the mainnet, and then we have issues, and then we are kind of like looking like, okay, what happens now, and kind of like if some exploits or bugs will be found. So there is no rush. There's many protocols which has been like public in terms of code and have successful launches. And this kind of like a more controlled, auditable environment is what the space needs. And this will help us go further and create bigger things. And even maybe there might be things that people might notice that you could improve your product. So definitely I see that more valuable than anything else.
Yeah, no, I agree. And I guess to start wrapping up, I'm interested in kind of your views of DeFi going forward, considering this recent craziness where these protocols, you know, launching very quickly and drawing hundreds of millions of dollars, have accelerated growth in DeFi, but at kind of a lot of risk, like you have highlighted. Going forward, I mean, what do you hope to see in terms of DeFi growth? Like, do you think it'll be like more sustained growth, like not so exponential, but maybe a more sustained kind of growth without so much risk? Do you see any risk of these protocols kind of producing some kind of crash which takes people away from DeFi for a while? Like, what do you see coming up next?
So the risk is always there. And as a DeFi protocol builder, for me, like the kind of like that part of life is serious. It's always there for each and every protocol. It's our job to basically keep these protocols as safe, as secure as possible, and ensure that basically nothing like this should happen. And that's how we support each other in the space. But basically, of course, the recent developments aren't helping the kind of like direction we should take. And because the safer we are, the more we get adoption, and the more we get basically institutional adoption, where we get large amounts of basically deposits and capital injections, but also we get allocations from larger amount of mainstream. Because if a system is seen as safe, then it's very usable to larger extent. Because it takes a long time to build a reputation, but short time to lose it. And basically what DeFi is now having is kind of like a bit of, I would say, testing in terms of like principles that kind of like, if we are able to come together and basically improve the safetiness of the protocols, ensure that we have a way of deploying code into the mainnet that is basically secure, that is attractive. That what gets people into the space, and we have a base layer for financial applications, products that we have never ever seen before, just because of the efficiency and the security that blockchain provides. And I really want to see that. And if there's something happens, the industry stalls with year or two, and that will be very shameful, because then all that we build it, we have to wait for the next kind of phase where the trust is regained again.
Right.
And I would not like to see that happen. I would like to see basically that the space will grow kind of like in a healthier direction. And it doesn't even mean that if you take the healthier path, it doesn't mean that we are going to grow slower. It actually might mean that we are passing more and more tests and are more battle tested, and actually capital comes quicker. And I think this is something we all need to realize just.
Yeah, I think that's a great point. Okay, great. And then last question is, you know, we started the conversation highlighting how Aave went from 0 value locked at the start of the year to 1.3 billion now, the second largest DeFi protocol after Maker. Do you, I mean, are you looking to overtake Maker? Do you see that happening?
I think like Maker as a protocol has done very substantial work in terms of like the issuing the stablecoin and amount of value that they have locked and how people trust them, and kind of like it's more quieter in terms of like the space, because it's a very base layer, and many of these things become a bit quieter at some point because you're providing the very foundation layer for the ecosystem. And I would say like Maker and Aave will be like that in the future. And I think the growth of the product and the brand, it really depends on the innovation that you create. Our goal is kind of like, we don't focus that much on other protocols, only to the extent that we can ensure that if a developer builds something on Aave, our composability allows them to use other things and basically build products that are using everything. That is like what DeFi is all about. And I think like these protocols that we see now in DeFi, they will be there if nothing like serious will happen. but yeah, I mean, I really love what we are doing now in the space in terms of like those baseline protocols, and I really love to see more innovation. And yeah, I hope something that is built on top of Maker and Aave will become bigger. That will be
interesting.
more awesome.
Yeah. Well, Stani, it was really a pleasure chatting. Thank you so much for joining me again. And yeah, look forward to seeing all the innovation happening on Aave.
Yeah, thank you, Camila.